Hello, this is Paul Gibson with the Academy of Trading and Investing. We are here today to add to your acumen of trading skills by looking at some more technical analysis skills. Today we'll be talking about exponential moving average versus simple moving average as a technical analysis chart. So, the definition of a simple moving average is an arithmetic moving average calculated by adding recent closing prices and then dividing that number by the time periods in the calculating average. A simple or arithmetic moving average that is calculated by adding the closing price of the security for a number of time periods and then dividing this total by the same number of periods. Short-term averages respond quickly to the changes in the price of the underlying average, while long-term averages are slow to react to those prices. An exponential moving average is a type of moving average that places a greater weight and significance on the most recent data points. The exponential moving average is also referred to as the exponential weighted moving average. An exponentially weighted moving average reacts more significantly to the recent price changes than a simple moving average, which applies an equal weight to all observations in the period. In other words, a simple moving average is going to average the closing prices over the period of time. So if it's a 20-day moving average, it will average the last 20 days worth of closing prices. If it's a 50-day moving average, it will average the last 50 days of closing prices. An exponential moving average is going to put more weight on the most recent data. So in a 20-day moving average, more weight will be applied to yesterday and the day before than on the first day of that 20-day moving average, thus giving the little moving line little more volatility and will react more quickly than a simple moving average. So we'll see our signals a little sooner with an exponential moving average. So, an exponential moving average places greater weight and significance on the most recent data points. It is used to produce buy and sell signals and crossovers or divergences from the historical average. And there are many different forms of this. You get to choose your own, but the most commonly used are 13-day, 20-day, 30-day, 50-day, 90-day, and even a 200-day moving average to help us view the trending of that particular stock price. So the moving averages are designed to help us see any potential trending. In other words, which direction is the stock price likely to go based on those moving averages. So let's take a look at a picture of the 20, 50, and 200-day simple moving averages. We can see that the blue line represents a 20-day moving average, the red line a 50-day moving average, and the green line a 200-day moving average. We can see those lines moving up and down depending on what the stock price is doing. We have a lot of volatility with this stock through this area right here. Let's look for a crossover. So we see that the 20-day moving average is the blue line, and it's moving up and crosses over the red moving average at about May 14th. Then we get another crossover going from the top above the moving average to below the moving average, the 50-day moving average, around, let's call it the 7th of August, just for fun. That's what it appears to be on this timetable. Stock price is going up, has some volatility, moving averages are following right along. You can see that the 20-day moving average continues to be above the 50-day moving average through this period, which means that we have an ongoing bullish function. And that bullish function ends right about here where that crossover begins. By looking at the candlesticks, you can see that the candlesticks begin to decline before we get that crossover, thus telling us that the moving averages are confirming signals. In other words, after the fact, they're going to confirm that whatever decision we made is correct. So here, it is confirmed that buying was a good idea. Do the stock prices go down after that? Yes, but we follow the moving averages, which tell us, hang in there, we're still in a bullish function, And then that bullish function ends right about here. We had some candlestick signals in advance of that that told us that we're moving in a bearish function now. If we're following candlestick technology, we might have sold that stock right about here because now we have two bearish candles after the primary bearish candle here. So once again, this confirms our decision to sell. Now, an interesting part of moving averages, I'd like to point out that whenever the 50-day moving average is above the 200-day moving average, which would be a bullish long-term function, if it goes from above to below the 200-day moving average, which happens right here, that's called a death cross, which is stock market parlance for we're heading for a strong bullish period. Now this applies to just this stock. It doesn't apply to the whole stock market in this case. So conversely, let's take a look at the 20, 50, and 200-day exponential moving averages. Here we see that we're getting a crossover on about May 3rd. So it's almost a week in advance, a little bit more than a week in advance of our simple moving average signal. So we would buy in this territory here. And then we get a sell signal over here on August 5th, which is a couple days in advance of the simple moving average. So by using exponential moving average, we're moving up our signal times, and we get a little more advanced notice, which can be helpful to a trader, as you might imagine. Now, let's change the data a little bit and go for a faster moving average. So we're going to take a look at a 13-day, a 20-day, and a 50-day moving average. So in this case, we see our buy signal on May 2nd. So at a day in advance of even the 20-day moving average crossover. And we see that we get our sell signal right on that second confirming bearish candle, which is what we'd probably want to see on August 3rd, a couple days in advance of even the 20-day crossover moving average. So I like the 13, 20, and 50-day exponential moving average signals because it gives me a little more time to be in the trade and advance notice as to when I should be making my trades. Now, if I were just following the candlesticks, I would be seeing this over here. I have a doji here, a negative candle here confirming that we might be going back to bearish, but then we get a Motobozu here, which is a very strong bullish candle in this case. Of course, a Motobozu can be bullish or bearish, but in this case it's a bullish candle, and I get a confirmation right after that. So, being a savvy trader, I might place my order to buy at 1% above the high of that day. In this case, it looks like it might have been around 950. So I buy the stock at 950. The stock price goes up. I follow the moving averages. It tells me to hang in there. And then I see that I have this bearish confirmation candle, and I get my crossover of the 13-day going from above to below the 20-day moving average, which is a sell signal. So I sell the stock. Perhaps I have placed an order to sell at $10. I just made 50 cents on that trade in a 3-month period of time. Not bad for a $10 stock. And I'm very happy with that trade. I just made some nice money. And the moving averages have helped me confirm my decisions to buy and sell. So, once again, this is Paul Gibson with the Academy of Trading and Investing. It's been a privilege for me to be with you here today to talk about additional ways of knowing when to buy and sell your stock. Of course, you're always welcome to go to academyofti.org for additional videos. We also have a great number of articles there about general philosophies and techniques for the stock market. And of course, if you're interested, we have very qualified coaches to help you with your trading. Now, you may have noticed that some other videos are done by professional actors. They may or may not understand the stock market, but they certainly have great presentation skills. Our videos are done by real professional investors with a long history of being able to educate and help other investors. That's the difference between our videos and the other videos. So I hope that you're appreciating the detail and the data and the insights that you're getting from these videos, whereas many other videos are mostly just hype to sell you something. At any rate, if you'd like, take a look at Notes from a Profitable Investor. It's a great book that will help you get a very comprehensive education into how to invest in the stock market. Also available on Notes from a Profitable Investor on Amazon Kindle. So it's available on your mobile device. It's been fun being with you here today. We encourage you to check for future videos that will help you with your investing education and process. We'll look forward to seeing you in our next video.